Lights on, screens glowing, numbers climbing. In the year 2000, one American company was worth more than Coca-Cola. It didn't invent anything. It didn't manufacture anything. It barely sold anything. Yet Wall Street called it genius. Employees called it destiny. Politicians called it progress. 1 year later, it was gone. Not shrinking, not struggling, erased. $63 billion vanished, thousands of lives wrecked, and the people in charge walked away rich. This is the true story of Enron, the company that turned accounting into fiction, confidence into currency, and belief into a weapon. Let's rewind. Houston, Texas. Enron begins as the most unsexy business imaginable. Natural gas pipelines. No glamour, no headlines, just metal tubes pushing gas from point A to point B. It's formed by a boring merger, the kind of company that sends Christmas cards to regulators. Then one man sees something else. Ken Lay, economist, well-connected, perfect corporate smile. Lay believed one thing with absolute faith. Rules are the enemy of profit. At the time, the government controlled energy prices. You charged what you were told. Margins were capped, predictable, safe. Lay wanted chaos, because chaos can be traded. If prices moved freely, energy wouldn't just be delivered, it could be bet on. Gas wouldn't be fuel, would be paper, and paper makes rich people richer. Enron didn't just move gas anymore, it started trading it. Long-term contracts, futures, hedges, swaps. If gas prices went up, Enron won. If gas prices went down, Enron won. If nobody understood how, even better. Then Lay hired a man who changed everything. Jeff Skilling, former consultant, aggressive, brilliant, zero patience for normal people. Skilling believed Enron wasn't an energy company, it was a technology company. We don't sell gas, he said. We sell the future. Wall Street lost its mind, because the future doesn't need proof, it just needs a story. Then came Enron Online, a digital platform to trade energy contracts instantly. Click, millions move. No factories, no trucks, no inventory, just screens. Suddenly, Enron wasn't Texas. It was Silicon Valley with oil boots. Media worshipped it. Business schools studied it. Executives copied it. Fortune magazine crowned Enron most innovative company in America 6 years in a row. Inside the company, pure pressure. Employees ranked each other. Bottom performers fired every year. No mercy. You didn't miss targets. You beat them or disappeared. The message was clear. Results matter. Questions don't. By the late 1990s, Enron was unstoppable. Stock price, $7 to $90 in 3 years. Investors felt like geniuses. Executives felt invincible. But there was a problem. The business wasn't generating real cash. So Enron changed the rules of reality. They used something called mark-to-market accounting. Here's the trick. Enron signs a 10-year contract. Instead of waiting 10 years to earn profits, they book all future profits immediately, today, even if the deal hasn't started, even if it loses money, even if it exists only in a spreadsheet fantasy. On paper, Enron looked unstoppable. In real life, it was bleeding. Losses started piling up. Bad investments, failed projects, energy markets that refused to behave. Enter the fixer, the CFO, Andrew Fastow. Fastow didn't fix problems. He hid them. He created dozens of shell companies, special purpose entities, officially independent, unofficially controlled by Enron. Here's how the scam worked. Enron dumps bad assets into these entities, pretends it sold them, books fake profits, keeps debt off its balance sheet. It was financial cosplay. One pocket paid the other. Money went in circles. Losses vanished. Fastow personally profited millions, and he named these entities things like Raptor because subtlety was dead. Executives cashed out. Millions in bonuses. Stock options exercised at the peak. Private jets. Vacation homes. Employees encouraged to put retirement savings into Enron stock. Their 401k was basically a loyalty test. When the stock froze during the collapse, employees couldn't sell. Executives could. Guess who did? Analysts kept shouting buy. Why? Because their banks were making millions from Enron fees. Objectivity doesn't pay. Access does. And the auditors? They were supposed to protect investors. Instead, they advised Enron on how to structure the mess and then approved it. conflict of interest on steroids. And when investigators came, documents vanished, hard drives erased, shredders overheated. It wasn't negligence, it was cleanup. August 2001. Jeff Skilling suddenly resigns. No warning, no explanation, just gone. Wall Street blinks. Then the SEC starts sniffing. Internal emails leak. Questions grow louder. One employee speaks up. She warns leadership. This will explode. Leadership responds with PR, not honesty, because truth doesn't move stock prices. October 2001. Enron admits it overstated earnings by hundreds of millions. That's corporate language for, we lied. A lot. Investors panic. The stock collapses. $90 to $1 in weeks. December 2nd, 2001. Enron files for bankruptcy. Largest corporate collapse in American history at the time. Thousands lose jobs. Retirements wiped out. Lives destroyed. Executives already gone. Fastow goes to prison. Skilling gets sentenced. The founder dies before sentencing. The auditing firm collapses entirely. 85,000 people lose jobs, not for fraud, but for helping hide it. New laws pass, new rules written, but the damage is permanent. Enron wasn't just a company, it was a mirror showing what happens when confidence replaces evidence, complexity replaces truth, and belief replaces accountability. Everyone wanted to believe, so no one asked the one question that mattered: where is the money actually coming from? And by the time they did, it was already gone. If this story felt familiar, it should, because Enron didn't invent fraud. They just proved how far it can go when nobody wants to look too closely.